Good evening, everybody. I hope you're good. And good evening, Adrian. Hi, Shane. It's lovely and a lovely evening in Perth. Sorry, it's a bit chilly in Melbourne. No, I need to send out recording links for each individual webinar. Although it's the same registration link, but it's a different link for each webinar. Good evening, Michael. Hope you're well up there. And so a little bit of a different session today. And I thought, okay, so in the spirit of some of the things we've been talking about this month, we've been talking about market IQ and systems IQ and all that sort of stuff. And this, if you like, is the ultimate market IQ sort of task, and probably worth adding to your list for those of you who attended the training development intermediate workshops. And if you didn't, I'll send you the recordings if you just pop me an email so you can catch up. There was a sort of trading development rubric where you could tick off where you are on certain things or score yourself on certain things so you prioritize, etc. This is probably one of the latter stage skills that I want you guys to think about doing. Good evening, Rachel. And what it is all about is just taking a breather, just taking a step back, because sometimes on the day-to-day action in the market, we get very embroiled with what's happening now and lose sight of what the bigger picture may be, and potentially lose opportunities or take risks that we shouldn't. So that's really the point, if you like, objective one or learning outcome one of this particular session is just to watch how I put this together, okay? Because if you know the process, again, if we know the process, then you can start to put things into place for yourself. So watch the process I'm using as well as the information I'm giving you. Obviously, the information I'm giving you is based on keeping an eye on things on a day-by-day, week-by-week basis, as well as what's happening right now, and as well as reading what the market is telling us on charts. So it's not just me smashing a load of facts and figures at you. It's really looking at what that or how that relates to what's happening in the market now, what's happening to market sentiment, and how and if that might change going forward. And of course, ultimately, particularly and tying in with last week's session, ultimately this may create some ideas about where best to not only place your money in specific positions. So I'm going to give you 4 stocks and 1 currency pair, but also in terms of how you may position your portfolio in terms of, for those of you who are trading multiple instruments. So for example, the last week has been, or the last few days has actually been okay for FX on a short-term basis, and has been more difficult with share CFDs. The 2 weeks before that were absolutely rocking for share CFDs, and were slightly more difficult in FX, and of course for indices. So by getting this, taking that step back and getting that overall market picture, then it gives you just that big picture stuff that you can subsequently take advantage of. Now, again, I'm not going to deliver the slides of this, but I thought it would be useful, particularly you guys who attend regularly, such as Shane and Rachel and Ross. Good day, mate. I meant to actually ring you today, so apologies, I'll talk to you tomorrow. And Adrian, of course, and Wayne. More than happy. You guys just email if you want me the slides, but I'm opening that offer up to anybody. If you think not only the information on the slides, but again, look at the process on the slides that I'm using. If you think that might be useful, then just drop me a line. Hey, Chris, good day, mate, how are you? So obviously we've got to put up this disclaimer and risk warning and say it's delivered. These are very much my opinions, not necessarily that of Go Markets, but I've got it pretty on the button for the last 2 times we've run this. It's a fairly recent innovation to Inner Circle. We tend to run one of these every quarter. I'm doing it slightly early than I would normally do. Normally wait till there's a few more earnings out, but we're getting in there early because I think the next week is going to be challenging. and but it does make predicting that a little harder, perhaps, because the picture is slightly cloudier. So, but of course, anything that you see or hear, you need to do your own due diligence on, make your own, form your own opinion of, and decide whether to integrate it or not into your trading thinking and potentially behavior. Of course, risk management is a critical part of everything we do, so that'll be part of the whole shooting match as well. So let's look at what's going across the news right now and what's influencing markets now. Before we go into the bigger picture, let's look at what's today. Okay, so the news today, we saw US equities continue to pull back again across all indices as earnings have failed really to excite. And there's little significant data. Yesterday and today have been very data quiet. And Mondays are always a little quiet in terms of earnings. When earnings season starts. Of course, it started last week with some of the major banks who ramp up from here for the rest of the week. And the US futures trading mixed to negatively. It looks as though they're starting to pick up a little bit, but we'll have a look at that in a moment. Asia have followed that overnight rule from Wall Street. Both the futures and Asia are off, or Asia finished off its lows. At one stage, the ASX was 1.4 to the downside, and ultimately, of course, it finished better. For those of you who watch these things, it finished much better than that. Then it was only down 0.3% due to a late rally. Could be that buying into the dips again. And of course, if you're looking at the European markets, they're actually all positive amid some positive earnings from Europe. So a very different vibe than what it was 6 or 7 hours ago. But again, this is one of the issues about looking at things on a day-by-day basis. You tend to get sucked in a little bit to every little bit of news, every little bit of market movement, and that's the danger. US dollar index has been all over the shop. It held on yesterday to a slightly positive day, and precious metals have paused, but we'll have a look at those in a bit more detail because there's something going on with precious metals that's interesting and I'm going to share with you. In today, and we've already seen this in Europe, sentiment is going to be dominated by earnings. There's not much coming out on the data front. There's some UK inflation data and Canadian interest rates, which is only going to influence any currency pairs with Canadian dollar. We don't think that the UK inflation, unless it blows out, is going to influence global markets at all, or the US. But obviously, inflation is one of the things on people's radars right now. So let's just look at some of the things behind this. Well, if we look at the futures to start with, you can see here that we've got a really flat set of futures. Really, the Russell is outperforming, has underperformed the other indices, to be fair. But there are obviously small cap as well as the big boys reporting, and some of those have come in quite well. But you see the NASDAQ is the lowest performer, and that's really due to Netflix, who did report a fairly significant decrease, a bigger one that the market was expecting in subscribers. There was a decrease expected, as we've obviously got some opening up, and most of the people who were going to open up Netflix accounts have opened them over the last 12 months. But that decrease was more than expected. So Netflix dropped 8% in after-hours trading. So that should be an interesting chart to have a look at come tomorrow. Now, what that says is that those that fail to meet expectations may be hit hard, particularly those that have had a good run-up. Okay, let's just look elsewhere. We see orders come off a little bit, but it's still in a relatively good price. We've got a move up over the last week, and Brent is in excess of 65, still crude. The WTI version of that is over 60. That's both those are important levels. And we see really the Kiwi outperforming on the Kiwi and the Canadian dollar, so two of the commodity-based currencies outperforming, along with the USD that's actually not doing bad. The euro is weaker, significantly weaker, so we'll have a look at that in a moment. If we look at the economic calendar, there's nothing going on. Retail price index looks as though it's sort of coming out. Let's just there we go. So again, we don't want to see things too hot, but we'd like to see things looking brighter, and indeed that's the case. So PPI is up a little bit. Retail price index actually down. That's pretty year on year, and as expected for month on month. So that's all relatively positive news in terms of not blowing things out. The 10-year bond auction, 0.25%. That's a German bund. That's less than was previous. So that again indicates pressure coming off bond yields a little bit. We'll talk about that in a moment. It's really the end of the week that things ramp up, really ramp up. It's quite an important week. We've obviously got the ECB interest rate decision tomorrow, but more importantly, the statement that goes along with that. And we expect it to continue to be accommodative. But we've also got PMI data and, of course, got US jobs. We've also got a rake of PMI data coming out on Friday from Australia, from the UK, from Germany, from the Eurozone as a whole, and of course from the US. Now that PMI data is going to be hugely important. That on top of earnings are going to be the two highlights of the week. And with earnings, generally in earnings season, we tend to get the bigger companies reporting Tuesday, Wednesday, Thursday, and so quieter sessions quieter days on Monday and Friday. We'll look at earnings. If you haven't got this link, I'm going to give you it. Just out of interest, and if you're trading shares CFDs, there we go. So if we look at Apple, for example, they're reporting next week. If we just look at what's happening now, you'll see what I mean about, I'm not going to go into stock by stock because unless you're trading US share CFDs, that isn't important. But you can see really how we're getting a ramp up of earnings on Wednesday and Thursday, far less on Friday. And if we look at next week, we see those ramp up again. So look at Tuesday, Wednesday, Thursday next week. That's when earnings season really kicks off, and that's when we'll see the major market opinions being formed. That's going to be important. We're going to reference that in a moment. Okay, so that's what's happening in the news today. Let's just look at some charts just to put some context behind that. So if we start with the Nasdaq, so this has really sort of been a flattish day, as I said, trading in quite a tight range for most of the indices. This is an hourly chart. You can see how we've just picked up a little bit over the last couple of hours since European market open, but there's that pullback that we've had over the last couple of days. So we're already 2.5% from our highs, but we've had a positive day today. That 13880 is the level to watch. If we look at the S&P 500, so we'll just pull that on. You can see again we've got about 1.5% drop on that, with a better day today on the futures contract. But these are record highs. We've got to put this into context. We're going to talk about context in a moment. Quickly look at the US dollar. We'll just look at this on a daily basis for right now. And you can see we've actually got a bounce potentially off 91. That could be important. So it could be profit taken at this stage from those who have shorted the USD over the last couple of weeks. And of course, if we look at gold and silver, we're actually seeing gold in an interesting place. So we're actually not down on gold today. We'll continue a move higher, and we're actually getting the 50 and the 20 EMAs looking to cross. We've got 200 EMAs sitting there, which is really important. But you can see we've held on to that, which suggests that US dollar trade is a profit take rather than at this stage, rather than a trend movement. It may turn into a bounce, but much will be dependent on what happens over the next 48 hours. And if we just quickly look at silver, silver is quite different. You can see that we are actually in a sideways trend on that after a move higher. So that's sort of interesting. Look at a weekly chart, you can see even more of a trend. Look at a monthly chart, and you can see even more trading within a range. So quite different to the way gold looks at this stage. And in fact, you could suggest that this is triangular, and that sort of fits with where silver is right now. And I'll talk about that in a moment. So quick look at oil. We said that it was up. I've been up over the last week. There it is. So it's still holding above 65. That's an important level. We did have a pullback after 80-70 and moved out of that range last week. And so holding on to 65 looks quite important. But again, in terms of perspective, look at where it's come from. And so not surprising, we got this sort of pullback of around about 13%, but we're already nearly 10% off those lows that we hit at the end of March. Looking at some of the currency pairs very quickly, just for right now. Here's the yen US daily. You can see that yen, that US dollar weakness, as we see in the US dollar index. Japanese yen and euro occupy most of what makes up the USD index, but you can see we're trying to find some support around about this 50 EMA. You can sort of see that there. So a pretty neutral day today. If we quickly slam on the there's the ASX, positive finish to the day, and look at this candle follow through since so some good retail sales numbers came out, but this is what we did today. We got smashed on open, and really from then we just went higher. And so quite a swing on the ASX, supporting this idea of wanting to hold over 7,000. So we only got one bar below that after the break. So that's an important level, but that wasn't what I was looking at or intending to look at. We were trying to look at the Euro USD. And there you can just see on the daily chart, we've just had a pullback. We got this breakthrough trade last week at 119.85. This 120 level is important. Let's see if we can hold on to that. But as I said, because of that US dollar strength today, got the euro looking a bit weaker. But that is where it stops. So we've got GB pound looking up, and we've got on the hourly chart, so holding its own on the daily. And if we just put the Aussie US on there as well, very choppy. We can see that big candle yesterday, really lots of interesting action going on there, but we haven't dropped significantly since then. And we are, if we look at the 30-minute chart, we do look as though we've found a bottom, but really that 77.32 mark is where it's at. Now I'm just going to put this back on a daily chart. In fact, I'm going to put it on a weekly chart just so you can see full context. And we're going to take some of these lines off as well. So all that being done and said, then we need to sort of get on with what we're sort of on about for right now. And so let's get back to the presentation, because I want to do this. Let me just, there's a couple of questions come through. Do I see a head and shoulders on the 1 hour Euro USD? Just quickly go back and have a look at that. Euro USD, 1 hourly chart. It does look like a head and shoulders at that stage there. Good spot. There's a shoulder, there's a head, there's a shoulder. You might even see it even better on the 4 hourly chart. There we go, shoulder, head, shoulder. But that break of back through 120 is important. So this next price move is quite important. You can see that the wicks are getting longer after their initial breakthrough about 4 hours ago. So yeah, this next move is important. If it continues in the way it is and actually sort of test 20, we could see it down to 1085 pretty quickly, but that's the more important level. But that's an interesting, good spot there, Rod. Okay, so let's talk about context for a moment. So despite the recent pause, US equity markets have come off record highs. In Europe, the DAX is similar. The FTSE is at pre-pandemic levels, and the ASX is only 2.5% of all-time highs, which were hit in February last year before all the pandemic news came through. And Nikkei was within 5% just since the recent pullback. If we just sort of quickly pop a Nikkei chart, you can just see how JPY, where is it? There we go. JP225 on a daily chart. So you can see really we had record highs kicking around here earlier in the year, sort of mid-Feb, a retest of those mid-March, and so we're only 5% off, although we are at an interesting point from a support level, and that's a pretty good textbook triple top formation going on there. So Nikkei is the index that looks under a little bit of pressure, but with even that 5% off the highs is not a big deal. Okay, so that's context. Okay, second, the US dollar index is at 2018 levels, but is 5% off its lows, and that's a big deal for the US dollar. 5% off its lows that it hit earlier this year. Now, could it go down and retest them? Absolutely, it could. If we just again pop this on a bigger chart, and let's pop it on a weekly chart just so you can see this. That's the S&P 500. We talked about that. So here's the weekly chart. Okay, so there's the lows that we hit from October last year. We retested them in late January. So we look as though that 9-to-1 level is pretty important that we're holding on to at the moment from a technical point of view. There was a lot of analysts out there talking about the US dollar was going to get smashed, etc., etc., but that hasn't happened. Okay, it's actually held on pretty nicely to that 89 low that we hit late last year. So the death of the USD is well over broadcast, and indeed some of the major banks in the US are calling that a bottom in the foreseeable future, and the reasons for that, which we will go into in another session. But there is always the chance of a retest of that, and I think technically we're looking as though we could do that. Maybe not this week, but perhaps over the next couple of weeks or so, we could see, particularly if we get some earnings that come in well, we could see that push downwards. So most major currencies are near 2-month highs. So versus the USD, so the yen has underperformed against non-USD currencies right throughout the year, although I did pick up a little bit of late. The other interesting thing is that there's been a recent disparity in precious metals, with gold in long-term downtrend with silver, while silver's been in congestion. And this may be signs that the balance is redressing. Also, sorry, there may be signs that the balance of that is redressing. We're sort of seeing a better move up now in gold than we've had in silver, which looks as though it's in sideways trend. So silver has continued in a range-bound state, whereas gold appears to be having a nice bounce and also ignoring US dollar strength and continuing to hold where it is. So let's just look at something that I thought was quite interesting that we don't often talk about, but we should possibly redress, is the gold-silver ratio. So generally speaking, historically, this is thought to be ideally around 65 to 70, okay? So if we look at where it's at now, it's at 68, okay? So it's in the zone right now, okay? And if anything, it's potentially got a little move up. So if we look at the 30-day, actually, let's take you back a little bit just to give you context about this. So if we look at a 10-year, there we go, there's a 10-year gold and silver, okay? And you can see really since for the last 5 or 6 years, then it's primarily been at a low at around about 65, and then we got that big spike through 2020 after COVID, where gold became a lot more popular than silver. Then it dropped off through the back end of 2021. We got all those moves up in silver that we saw and continue to do so. Now we're seeing a slight change. Okay, so if our new average is around about this 80 level, then there looks to be some support for an increase in gold. So perhaps that might be one of the things that are being looked at. central banks tend to use gold as a longer term hedge against a number of different things, and would tend to short silver quite frequently. Retail investors tend to trade silver more than gold simply because of its price. But we can see here that we've just got this uptick, okay, over the last few days in where this ratio is. So we could see it push 70 and perhaps even up as high as 80. So back to this sort of norm here, if we look at a 2-year chart, that would be bullish for gold and neutral for silver. So if you are thinking of a precious metals investment, maybe that gives you a clue about which one you should be planting your flag in. Okay, so that's that done. Oil is within 5%. We've talked about that. We've sort of said tech's outperformed, but with some justification. People sort of said, "Oh, tech, it's way overvalued," but actually, it's very different to 2000 because it's based on real results. It's based. The tech bubble of 2000 was very, very speculative in so many ways. Now, that's not saying that tech stocks may not be overvalued, but by necessity during COVID, we had to accelerate some of the things in tech, which are ultimately going to change the way business works to some degree. Now, what that new normal looks like, of course, is anybody's guess, but there is a change, and a change that possibly would have taken 3 or 4 years has taken 1 year. So a number of things, different agendas are pushing that, and so there is some justification for tech outperforming, but whether the valuations are real or not, or realistic or not, remains to be seen. We'd expect tech to trade at multiples of earnings far greater than that of perhaps, and by perhaps than some of the banks, etc., which are considered actually to be undervalued. If you look at Goldman's earnings last week, looking at the book value of Goldman, if you took the 10 times earnings, then Goldman's price should be kicking around about 400. It's not at that level at all. It's a little shy of that. So there are this overvalued label that's been pinned on equity markets is not really wholly justified, and will be further justified or otherwise in earnings, which we're going to talk about in a moment. If we look at the data that's coming out, there's continued slow recovery despite the presence of lockdowns still globally. Obviously, there's a bit of a there's a major disparity between various economies, and there are countries still being really significantly hit. Now, any incidence is bad incidence, any deaths are bad deaths, of course. But you look at the numbers coming out of India, and you look at although they were later to the COVID game than perhaps the US or Europe were. You look at some of the numbers still coming out of the US, and they're quite staggering, despite the optimism. The data is really important. There has been this improvement consistently, although we did get a little slowdown last month, and that's what makes this Friday's PMI data really very important. Now, the other thing that's changed, apart from the norm, is the service PMI data, which is still struggling to perform well. Manufacturing PMI seems to have picked up. We are most definitely in expansion in most of the developed countries, but service PMI remains below 50, although less so. Now, just for those of you who are less familiar with the PMI data, it's essentially a measure of expansion or contraction. If it's above 50, it means it's in expansion. If it's below 50, it means it's in contraction. We're still seeing contraction in service PMI numbers, but the trend is better in that there's a slowdown, a significant slowdown in the contraction. Employment figures, GDP figures are really as good, if not slightly better than expected. Although again, we've got slower growth recently. So this next month's figures have got to be good if we're going to see some continued optimism. And of course, beneath all that, the whisperings about long-term inflation remains an underlying concern. Primarily at this stage, it's driven by soft commodity prices, which are pushing food prices higher, and oil prices. But central banks are going to be accommodative. They've said that. They're not going to do anything in the foreseeable future. Late 2022 is the earliest they might start intervening on that. They're going to be okay as long as inflation stays below that 2.5% in the US. After that, it might get a little stressed. But there's disparity between what the bond market thinks and what the Fed thinks. They'll go against the Fed, and you're asking for trouble, generally speaking. But that's what happened recently. The Fed says there's no drama. Inflation numbers are still low, which they are. But bond yields spiked, particularly on the 10-year, and that sent the markets into a temporary tailspin, particularly tech sector, which is very, very influenced by interest rates, and corrected 11%. Now, where are bond yields now? Well, I'll show you. If we look at a chart of the US bond yields, there you can see the fairly significant growth. So our worst was 0.3, just to put it into context. Our historical norm, okay, our historical norm is somewhere around this 5%, okay? So just to put all this into context, if we go a 5-year, you'll see the lows were hit last year. I think in March it actually hit. I don't think it's going to show it on this chart. Let's get it right bang smack. So this is a 10-year, so it actually dropped to 0.3 something intraday, but 0.5 generally. But you can see that really sort of rapid acceleration in bond yields. So this is the 10-year. This was one of the key reasons why equity markets kept going up, because 1.1% is not attractive for institutional investors to have their clients' monies put in as a return, and particularly when you compare that to dividend yields. But with equity prices going up, with bond making the dividend yields less attractive and bond yields going up, that lessened the gap, and that was one of the reasons why we saw that equity market drop off. But you can see now, since those, if we just look at a 3-month chart, so we're off the highs that we hit there mid-March and towards the end of March. And if you look at where this all started really sort of going wrong or getting concerning around there's early March. So if we look at the equity market chart, we'll just look at the US 500 daily, we can see, just put on daily chart, you can see early March, we saw it late Feb, we started to get that drop off, and that was that pullback we saw at that stage, and then again towards the back end of March. Since then, since bond yields have stabilized, this is what's happened to equity markets. Absolutely, it looks exactly like the S&P 500, that chart, and that's because of the close correlation between bond yields and equity markets. The flow between the two is based on where institutional investors see the best value for some safer investments, be that dividend yields or bond yields. Okay. So, but inflation data, which usually is what drives interest rates higher, because obviously if inflation starts to rise and the Fed will potentially look at raising interest rates, that will be reflected in treasuries and subsequently passed on to us with mortgages. And then of course we've got a situation where people's money is better placed for long-term investments, sometimes in the safer bond yields. So that's where the data is right now. And then there's the relationships. Most of the usual relationships are still intact, although there's been a little repositioning. So we'll give gold and silver as an example earlier, but those relationships that have been in place over the last 12 months still seem to be in place. We've still got this inverse relationship generally between equities and the USD, although there are more variations of that than there's been for a while. We've still got this inverse relationship between USD and precious metals. Again, I talked about that before. And of course, we've got the general FX correlations. We expect commodity-based currencies to move together. So Aussie dollar, Kiwi, and Also, the euro and commodity-based currencies are very highly correlated. We talked about this a little bit on last night's session. And then we've obviously got a relationship between commodity prices and commodity-based currencies. They tend to move together to a degree, and so that relationship is still there. The VIX is increasing, but that's really a reflection of earnings season uncertainty, because it's obviously difficult to pick where markets may be and what earnings may come in like. Now, cryptos, I'm not going to talk a lot about cryptos, but I will mention it's sort of interesting. I'm going to say no more than that. If we look at Bitcoin on a daily chart, now what's happened with cryptos is quite simple. Is every time there's been a retracement, there's been a heap of buying comes in and it goes to the next level. So we can see this time and time again. I know some of you like to short-term trade cryptos. So you'll see this. Now this one is different. So you see here that we've essentially got higher lows. Okay, we've also got to some degree a decrease. Whoops, that was a really badly drawn line. We've also got a decrease in the degrees of highs. In fact, we didn't get a high there at all, but we'll take that into, we'll let that one slide and we'll look here. So this is really quite an important level. At no point, and we can sort of even go back here. Okay, at no point have we seen the lows break the lows of the previous retracement. Okay. So technically, you could argue that this 17% pullback we're seeing in Bitcoin, which is taking it back down to this level at 55,000, is really quite an important level. I mean, this is a remarkable run, whichever way you slice it. So, and we are pretty used to seeing pullbacks of significant levels. So there's 32. This one was 22. This one was 15. This one is already 15. Okay. But as I said, the key factor with this is if it breaks this line, it will create a lower. I'm not sure what it did to the chart then. No, wasn't that. That will create a lower peak or break the previous lower peak on this. So this could precipitate more selling. Now, is that the end of Bitcoin? Let's just have a quick, well, of course it's not. Bitcoin has justification for being in this level at this level because it does now attract institutional investors. We also get in a number of central banks talking about having digital currencies, which may be part of the reason for this drop. And is an interesting development, but we've also got companies like PayPal, etc., now accepting Bitcoin. So there's a number of reasons why it's moved up here, but there is also a number of concerns as to what might happen next. Now, it may be that some of the money is coming out of Bitcoin into some of the other cryptos. We'll look at Ethereum here, which is not a dissimilar picture. So every time there's been a pullback, there's been another buy. Okay. But again, the picture is the same. We're not getting, and we can sort of just move my thing out of the way. There we go. Okay, but again, the same has been the case in that those lows, those pivot lows associated with the next move up, have never been breached. So Ethereum's got some way to go before it does that, but you would imagine, but again, to give context on this, we are down, this stage 11%, but we're actually down 20% on Ethereum, but we've got, so just watch this level on this, because again, the same could happen. If we get that breach in Bitcoin, we could see this translated to other currency, to other cryptocurrencies. So The question is how far will it go? It's not the question is it going to disappear into nothing? Of course it won't. But the question is, how far will this sell off if we do get that break in Bitcoin? Is that going to influence the other currencies, cryptocurrencies, or is it just a move out of Bitcoin into some of the cheaper currencies, cheaper cryptos? Currencies on the brain. And one of the other things that has possibly sparked this is it's maybe seen as a better inflation hedge than gold and silver at this stage. So that's all I'm going to discuss about cryptos, but I thought that was interesting, and if I'm going to be thorough, then it's obviously well worth doing that. Let's get rid of our drawings. Okay, so the tailwinds to the markets going forward, look, whichever way you slice it, we're in a low interest rate, low inflation environment with accommodative central banks. And still late 2022 and probably 2023 is at the earliest before there be any central bank hawkish intervention, unless something dramatic changes, like unless inflation starts to rocket higher. We've got continued economic growth backed up by data, although the next lot of data is really important to see whether there's a pause in that or whether there is any scope for a further up move. There is early earnings are coming in positively, and there is more money to come in from US infrastructure spending. That's obviously going to benefit infrastructure stocks, but much of that may be priced in already. We've got a stabilization in bond yields, and we've got vaccines and reopening going on, albeit at a slow pace and desired. So those are the things that are going to help markets higher and help US dollar lower. On the flip side, we've got a slower global growth potentially. COVID may yet jeopardize reopening as expected. And we've got vaccine concerns, blood clots, although they're very, very rare, like 1 in every 6 million or something, ridiculous. They are a concern, and pharmaceutical companies have a responsibility to check these out, and the FDA has a responsibility to pause while these things are explored. However, the flip side of that is the vaccine hesitancy that this is causing. So, particularly in the US, and it seems to be, it's really bizarre. So all of that stuff that Trump was doing pre-election, not wearing masks, talking about the vaccine, some of the material that's going out to that particular part of the population suggests a massive disparity between Republicans and Democrats and the messages and what the impact of the messages has had. So, and the differences are quite staggering. I can't remember what they are off the top of my head, but it's something like 85% of Democrats are cool with it, and only 45% of Republicans. It's quite amazing. Now, every time something happens, and there's this hesitancy is likely to be increased. So what does that mean? Well, it means if there's lots of people flying around without being vaccinated, and we don't hit herd immunity, we don't hit 80% of the population, there is always the possibility of new strains. New strains will not only kill those who have chosen not to have the vaccine, but as you get continuation of mutations, we may ultimately get to mutations which don't respond to the vaccine. And so potentially, although we're looking far down the line, it could precipitate another wave globally. So that's the problem with vaccine hesitancy. Now, what measures are put in to persuade people to have vaccines remains to be seen. But obviously, if there's things like vaccine passports, which allow people to travel, a ban of non-vaccinated people in various environments, certainly some of the universities in the US are insisting on it, that going forward, they're going to be insisting on evidence of, and not only evidence of clear tests, but evidence of vaccines. So there may be measures put in that are just going to twist people's arms to say, well, look, it's in my interests to do so. So that is still playing out, and so, but that is undoubtedly a potential headwind going forward. Commodity prices may exert further, both soft and metals may exert further, soft and oil may exert further inflationary pressure. Bond yields may start to rise again. US-China tensions may explode beyond the rhetoric. Equity valuations may prove not to be solid at this stage if earnings come in weak. And ultimately, if we look at the Australian dollar, for example, if the Aussie dollar gets too strong, the RBA are chilled about it now, but if the Aussie dollar gets too strong, we see it moving, see a gross drop in the USD, for example, see the Aussie dollar topping 80 again. We could get the RBA starting to get a bit twitchy about the competitiveness that may have, or the implications on competitiveness for some of our businesses. But again, that's significantly down the line, so not a current headwind. So let's just quickly cover earnings. We're in earnings week 2. Honest expectations were theoretically low, but we're not sure how much is priced in. And of course, there's a potential impact, and this is why it's so important, whatever you're trading, on not just the US market, but also the USD, and so all asset classes. We also, on top of that, have ASX earnings season starting next month. Remember, the ASX only have an obligation to report every 6 months, with the exceptions of those companies that are listed on the US as well. And there is some strong correlation between US and ASX in some sectors. So historically, there's been a correlation between 75 and 90% of earnings results in the US banks versus that in the ASX. So logically, the US banks blew it out of all, blew expectations out of the water. I mean, really absolutely smashed them. So does that mean that when banking earnings, so the ANZs and the CBAs and the Macquaries and the NABs and the Westpacs, when they start to report next month, does that mean that they're going to get a similar pickup with similar results? Now, the other thing is that markets are still very cautious. They're not getting ahead of themselves. We've only had a handful of earnings in, but 90% of those, so we've had less than 15% of companies reporting so far. But despite that handful, 90% have beat expectations, both top and bottom line. Now, that is spectacular. Normally, you would hope on a good earnings season to get around about 65% beating expectations. But there has been a tepid response to bank earnings, and the misses have been treated with no mercy. So again, it's difficult to project what this may mean going forward, because there's always an unusual response to bank earnings. That's historically, even no matter how much they beat, there's always a sort of interesting market response to that. So it's really once the industrials come in, once the big tech starts to report, that we'll see really how the market feels about this earnings season. So really, towards the middle of next week, we'll get a clearer picture of what that looks like. But I remain optimistic. And then there's the other stuff. Technically, there's invariably a correction at least once a quarter. There's no reason to expect this quarter will be any different. The timing of such is usually a few of these concerns, a few of those headwinds coming together all at once, and the market thinks, oh, too hard to work out what might happen here. So let's just sell off and see what shape the world is in a couple of weeks. Now, the only exception to that is bond yields. If bond yields start to spike again, we will see a sell-off in equities. They can move markets on their own at any time. And of course, what we don't know is that there's a new business paradigm post-COVID, but we're not sure what that looks like. Disney were a great example of how this changes. They put masses of cash into their online. Obviously, their parks have been shut there, so they really focus their energies on re-engineering the business. So there was a major online presence. The Disney Plus channel took off, was given a massive amount more investment than it would have otherwise done, and hence Disney's earnings last quarter were particularly good. It'd be interesting to see where that's replicated. So some of that re-engineering of businesses will have a positive impact on earnings, but it will also change the way we do business and change things like travel, etc. So let's get to it. We've talked around all the issues. Now, I hope you've been sort of watching the process. We looked at what's happening now. We put it into context. We looked at headwinds and tailwinds and what that might mean. And we've obviously got to make a judgment as to which is stronger. So at this stage, I'm planting my flag. In tailwinds are still slightly stronger than headwinds, but not to the same degree perhaps as they were last quarter. And part of the reason is slower than expected vaccine rollouts and reopening concerns, which are going to drag on economic recovery and reduce the reopening trade potential, which means small caps and so-called growth stocks value stocks may just still be a little slow to respond. Earnings may be starting to pant or even paint a positive picture, although next week, as I said, is critical. I suspect, and again, I'm planting my flag in a better than expected earnings with at least 70% beating expectations, simply because expectations are still quite low. So it might be good for the overall market, but those who don't will get hurt. So it really says if you are trading share CFDs or straight shares or even indices, because there will be a very short-term impact if, like Netflix, as we see here, if you're short-term trading indices. So at worst, there'll be a pullback, perhaps a correction in tech, particularly if there's bond yields rising. But I'm planting my flag in a better quarter end than is current in the US and on the ASX. So really what that means is record highs by the end of the quarter. There's no reason to suspect that the USD will break early or the lows that we hit earlier in the year, which will support commodity-based currencies. The euro and the GB pound, that isn't the euro GB pound pair, will be dependent on reopening. But again, because of that US dollar weakness and because the UK is actually moving relatively positively on vaccines, again, I'm suggesting they're going to be higher, but possibly will underperform the commodity-based currencies. So what does all that mean? In terms of where I'm planting my flag, just looking through comments and questions here. Okay. Do I see reported chip shortage? Absolutely. Which may benefit the chip stocks. I'm not planting my flag in a US share CFD, but if I was going to do it, it would be in the chips. And there's a couple of other things, right? So what does this mean? Where am I planting my flag? Well, I think there's going to be further strength in metals, which is partly going to be driven by all these infrastructure spending. This is going to be good for commodity stocks. I think Australia are where to look out for that. And I do think Oz Minerals will have actually held up on every pullback. If we look at an Oz Minerals chart, we are at record highs on those, but those are in the right space to benefit from this. So let's just slap an Oz Minerals chart on here. So we have had this small pullback, but you can see again, we've got higher lows on every pullback. And we had a positive day with a rejection of a further move down today. And so that support is in place at around about 24.13. So I would see this up $26, $27, perhaps even higher than that. So that's one medium term. In the short term, you'd probably wait for a break of $25 to be interested in this. Okay, I think the reopening story will continue. I think vaccine concerns will be weighed against the risk of not getting vaccinated, and Asia will go with vaccines. If we can get Scott Morrison keeps his gob shut and doesn't keep on banging on about how awful Europe are and not getting all these vaccines to us. Vaccines seem to be available and being distributed, been slapped in people's arms. So although there may be delays in what we would like, I think it'll still be good and it'll be improved compared to what is currently the case, and we'll get targets hit. And I can't move away from it. The travel stocks have got to be a beneficiary of that because we are going to get Asian reopening. Now, this is an interesting chart. We've been banging on about Qantas and $5 for a little while. Now, it actually broke that today. So there's the $5 level we think is important. So although we think Qantas could be the story, we see this 200 MA and it just sort of looks a little scary. If it breaks this 200 MA, we're going to get a continued pullback. So if we don't, and we get a bounce back towards that $5, if it breaks that, then we've got a reversal in place, and that would be if you like, the technical refinement of an entry, but I would certainly see that up at least to this 550 level and perhaps even test $6 if there's any Asian corridors reopened. But be patient in terms of the entry. We've been talking about this for a couple of weeks now. Okay, so correlation between the US bank earnings and AS banks are going to benefit those banks over here, theoretically, with good earnings. And the two that stand out are ANZ and Macquarie. Okay, those have the biggest reach. Macquarie is a slightly different beast in that it reflects the investments banking side of things that JP Morgan and Goldman Sachs are heavily involved in. So now I've already stated Macquarie is a favorite of mine. Last time we talked about a positioning, but we'll just have a look at those. But I think ANZ are more likely to be earnings, and so that's where I'll plant a medium-term flag. So we'll just put ANZ on here. So we'll just put this on a line chart. If we want to refine the technical entry, then again, there is a point, there is a line in the sand. So we'll look at ANZ above $29. If you prefer Macquarie, because I think they're going to smash it out of the ballpark as well. Again, this has been one we've been tracking for quite a number of weeks. Look at this candle today, a complete rejection of a move down, move back up over 155, which looks like an important level. So that looks pretty impressive. But again, if you're looking at this for a long-term position, it could be 197 or 158 over that. But you can see it's still very much an uptrend. And really, this is just treated as a retracement. This was quite spectacular today. Okay, so continued move away from fossil fuels. The electric car story is very much on the agenda. It's one of the big changes. Again, it's been accelerated across the globe, and so really it's hard to go past the lithium story that's needed for that. If you're trading the ASX, then there's two stocks that stand out, both of which have done well and both of which we've talked about on live market updates. So if we look at Galaxy, there's Galaxy. Again, look at today. As soon as there was a pullback, we've got selling back into that. We've got some merger talk going on. But as I said, we've been talking about this ever since that break of 280. The other one we've been keeping an eye on. We did pull back a little bit today. Was PLS, so Pilbara Minerals. So there was the breakthrough we identified on the live updates again over the last couple of weeks. There's the move higher, but again, you can see quite an attractive candle rejecting any further down move today from that. So it'll be interesting to see what the next move in that. We've got a nice line in the sand on PLS as well. So again, it's a plant your flag. I think PLS, I think a lot of Galaxy may be to do with the merger. And so that a lot of that may be priced in. So I'm wondering whether Pilbara Metals have got, or Pilbara Minerals have got the greater upside potential. These are both at record highs, just to put it into context. Once it breaks that 135 level. Just got an e-bike. How very cool is that? It's got a lithium battery. I wonder. That's a really good call. That's a really good call, Alison. Look, I reckon that'll explode in Asia. So I hadn't come across e-bikes before. That's cool. I might have to look at one of those. I like the sound of that. But that further substantiates this in terms of a thought. The flip side to that, of course, is the chip story. Porsche actually had to delay production of its cars because there wasn't enough chips to put in them. So that's interesting. So that auto sector has done very well in the last few months, but that's been a drag. So it'd be interesting to see if that offsets the lithium story. Okay, and one last one. I did promise 4 and a currency pair. I'm looking back at the euro, at the Aussie US. I did plant it in the Japanese Australian dollar last time, I think a quarter ago. So if we just look, there's Aussie yen. So it hasn't done particularly well in the last month. In terms of it hasn't gone up anymore, but when we're talking about this sort of stuff in January, it has actually gone up since there. So I think there's going to be further Aussie strength, but I think the Aussie US could be a better place to plant your flag. I think on the weekly chart, once we get over 78 cents again, we'll be pushing up to that level there, and then onwards up towards 80. Just again to put into context, if we look at the long-term chart, that's why I think 80 is the level where we may hit this quarter and perhaps even go through. Above that, and the RBA may starting to get a little twitchy and looking at ways to weaken the Aussie dollar without raising interest rates, which of course happened in New Zealand. So that's the currency pair and plant my flag in. If you want two US ones, oh, okay, one more Aussie. I do like JB Hi-Fi. I think they're a great company. I think they're in a good place. They again had a really good session today, despite a so actually closed higher, but you can see a complete rejection of a move downwards. Just put it on a line chart to make sense of this. So short-term breakout will probably take it up to around about $54, and above that we could shoot. So I think they're very well positioned in the retail space, probably better so than Kogan, although Kogan is attractive because it's got so far to go up. In the US, there's two that we like. We like the, you notice I've kept away from Afterpay and Xero. I do think those have both got upside potential, but we'll talk about those on tomorrow's live daily thing because they're obviously bouncing around a little bit right now. But in the longer term, I still like Zip as a medium term. But in the US, let's just let this catch up. I think we've had a healthy pullback on a lot of the stocks that have done well in the tech sector. I think Micron just continues to demonstrate good strength. Certainly not ready to rock and roll now, but already we've pulled back from around about 9% from the lows. I think we may, if we can hold on to, let's just put this on a line chart so you can see the Y. So if we can hold on to this 85 level, that would be the ideal entry point for a potential bounce, which we talked about a couple of weeks ago on Inner Circle when we looked at that as a strategy. And PayPal, I just think get better and better as a company from a fundamental point of view. Earnings are a little later. Just check in earnings on when these are due. There's 275 or 276 is the so a break of that. I could see it retesting 300. So a nice 10% move up, 9% move up there on PayPal. So there you go. So that's my flag planting. I've given you a couple of extra because I'm a nice guy. I hope that's been interesting use, but as I said, it's as important to look at the process rather than just the right. You mentioned the US. China in the report and selling on any pullbacks. Is this still a long-term thing to watch? Let's just have a look at that. So there's two ways you can play China. So we can look at this. And let it just catch up. So there's been a major pullback on this. So I've got Chinese strength now. We're I actually think that this might go lower. I think we might get down towards this 640 level. So that's one way you can play Chinese strength, I guess. The other way is obviously the futures contract, the China 50. So if we look at that on a daily chart, I like this. The Asian story is good. Let's just catch up with the data. So you can see how much that is being supported by the 200 MA. It's had 1, 2, 3, 4, 5, 6 sessions where it's tested that with, on some occasions, with quite a significant move, and it's been rejected every time. The fact that it's bounced off that and is moving up would now suggest that this looks like a buy in the short term with limited upside, perhaps around about this 3%, but after that we're sort of potentially up 7 or even 9%, which on an index is spectacular. So if I was to plant a flag in an index, it probably would be the China 50. Yeah, no, that's all good. That's all good, Josh. That's all good. I knew what you meant. Okay, guys. Well, look, I think that's probably it for today. I hope that's been interesting, sort of useful, sort of some benefit, and giving you some ideas. You're very welcome, Adrian. All it remains for me to do is, look, if you're not blocked into the, as I said, we're going to talk about some other stuff tomorrow on the live session. So just if you want to pop along to the lunchtime session tomorrow, you're welcome, Rachel. Just going to pop it in there with lunch next to it and then send you it. As I said, if you want the slides from, as I said, you're all welcome to drop me an email. I might regret that. You're all welcome to drop me an email. It's great to hear from you anyway. Just drop me a line, let me know how you're doing. But if you want the slides from tonight, then drop me an email and I'll flick them through. But as I said, look at process, not just what I've said. That's really important. Oh, David, I completely agree. And I'm guilty of that as well. Sometimes it's very easy just to get sucked into what's happening day in, day out, and to zoom out and just get that bigger picture is really, really important. So completely agree, David, and I hope that sort of reinforced that message. You're welcome, Brett. Cheers, Mike. Oh, you're welcome, Alyssa. Hey, I'll respond to your email today. Sorry about the delay on that. First steps, next steps. Just make sure you can get access and drop your line back if it didn't work out. Good, Josh. Glad you've got some stuff to think about. Cheers, Wayne. All good. Okay, guys, enjoy the rest of your week. We'll see some of you in tomorrow's lunchtime session. It's always great to have you along, and we'll pick we'll not only look at these picks we've made, but we'll start to unpick a bit more of earnings. We'll get some more numbers across today. And of course, we'll have a look at some of our favorites and see how they're performing going forward. You're welcome, Shane. Take care, everybody. And thanks for your participation and questions. It's always awesome to hear from you guys. Catch you later. See ya.